Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about the 4 major signs of a bad investment you've got to watch out for. So yeah, everybody loves a good deal, especially us Rule 1 investors. When it comes to stocks, we love it. As Rule 1 investors, in fact, we absolutely insist that we get a super good deal because we're going to buy companies below their margin of safety price. So it's like we're not buying something unless we're buying a $10 bill for $5. So we already got that down. But there are 4 other factors you got to consider before you commit to any companies, because a stock that's quote on sale isn't always on sale. Maybe it's cheap for a reason. So let's take a look at these huge red flags and those great signs of a bad investment that you should be running in the other direction if you see. First one is the company's loaded up on debt. That means it's got more than a couple of years of free cash flow to pay off the debt. Big debt can kill. Why? Because you get a bad management team, which I'll talk about in a second. They can really just run off into bankruptcy court and say, gee, we got too much debt and let's get rid of all of our shareholders. And they do it all the time. Horrible. So don't let them have the chance. Stay away from everything with big debt. Now, bad management, which can impact big debt, is really pretty much easily seen by looking at return on invested capital. Return on invested capital, or return on assets is another way to look at it, is basically how much money they're making with the money that we're leaving in the company and what they can borrow. Hopefully they're not borrowing anything. But if they are, we want to make sure that they are getting a good return on that money. A good return on invested capital, 15%, something like that. But the main thing is it isn't going down. If it's going down, that management team might be turning traitor on us and going in for themselves, and only thing left for us is maybe a little trip to bankruptcy court. Third thing, no moat. Man alive, this is such a huge deal. If a company does not have a durable competitive advantage that's intrinsic to that company, then it doesn't have a moat. And if it doesn't have a moat, then guess what? There's no way to know where that's going to be in 10 years because they're going to get it wiped out by competition. And what we really want to own is a company that can sustain itself through inflation, through big events that happen that create a lot of problems, through recessions. We want a company that comes out of all of those things bigger than ever. A moat makes a company anti-fragile. In other words, it does better when things hit the fan. That's what we want. So we got to avoid debt. We got to avoid bad management. We got to avoid a no moat company. And more than anything else, we have to avoid buying a company that's too hard for us to understand. Come on, we're just ordinary people. We're not going to be able to understand every company that's in the market. Seriously? You really think you can go and understand Intel or something? Are you a rocket scientist? I don't think so. I'm not. I can understand a burrito company, all right? I got to have stuff that's simple to understand. If it isn't a lemonade stand, I'm probably not going to be able to buy it. So do not get involved in companies that you think you understand, but you actually don't. Now, I'd love to hear from you guys. What other red flags do you look at in companies during your research? And just leave a comment below. You guys will be happy to answer your questions. Be sure and follow up with you. Now, thanks for watching, and go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about the signs of a bad investment, hit the like button and please share this video with your friends. And if you want more investing content, we got a lot on my channel. And don't forget to click the button on the screen for a free gift. And thanks again for watching.